Warren, we've talked about a lot of things this morning. We got briefly your thoughts on the markets, but there's been a lot that's happened in the markets since the last time we sat down with you. Volatility is back in a big way, and that has the average retail investor kind of questioning what to do at this point. It's scared a lot of people. What do you think's happening right now, just in terms of the return of volatility? Is it something to be worried about? What's causing it?
Well, if you own stocks like you'd own a farm or apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. In the S&P, you can just look at the figures for decades, has earned on tangible equity. It's earned a lot more than that, and it translates into higher prices than it should.
Is there a tipping point along the way, or is it a gradual decline in terms of
Nobody
these
knows.
things?
Yeah, but it is gravity.
If I told you that the long bond was going to trade at 4.5% to 5% next year,
it makes a difference. But it's been idiotic to own long bonds. During the last, I talk about this in the report in terms of it's just been idiotic. And big public pension funds and all that, they sat there and they own bonds. Now, they may have bought them on a 4 or 5% basis, but if they go to a 3% basis, they're selling way above par. The way people think about it is they do some very silly things.
I mean, you lay this out in the annual report, but a lot of investors are told, retail investors are told, that they should have a certain percent of their portfolio in bonds. Maybe they're told 60-40, maybe they're told 70-30 stocks to bonds. That's something that you should do, and that's the safe way of doing it. What are they missing? Some
people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
Do you feel like that's a message that is getting through to people? It's one that you repeat again and again. And I always feel like I was watching a lot of the Olympics, and I felt like what they do in the Olympics is so easy. These guys sailing through the air and doing massive spins on the ice and turns. And then I read your annual letter and I think, oh, it's really easy to invest. And then I walk away and realize it's not that easy.
It's not easy psychologically for many people, but I've been teaching since I was 21. I taught my first class on investments, and I had a class last week with 11 schools, 220 students, and some of them get it and some of them don't. People would rather gamble. I mean, the idea that you can double your money in 6 months, that's just going to, it's why people go to the races, why they go to Vegas, whatever it may be. They even know the odds are against them, and they still do it. I mean, it's a strong instinct to want to get rich fast, and I don't know how to do it.
All right, so based on what Warren Buffett has said, and your request for me to look into the SPY, the IVV, and the ticker VOO, that's Vanguard, I'll be doing a detailed analysis of these 3 top ETFs at this time. And for those interested about learning about ETFs, you might want to subscribe to the channel and turn on the bell for notifications, because on this channel, I talk about ETFs following Warren Buffett's principles. So let's talk about the first ETF that we have for the day, which is a very well-known name on the channel, the Spyder Sp 500 ETF. The ETF has 411 billion under management and has seen a 5-year growth of 93.02%, which is absolutely amazing. The dividend yield on this ETF is 1.29%, and we've seen this ETF dividend grow by 4.73% over the last 5 years, which speaks to an excellent growth story. You might also want to know that this ETF has grown its dividend for 12 years, which is stellar. Looking at the expense ratio of 0.09%, that is pretty low for an ETF like this. And finally, a quick look at the holding breakdown shows that the technology, healthcare, and financials occupy the largest positions in these ETFs, with strong names like Apple, Microsoft, Amazon, Tesla, Nvidia, Berkshire in this ETF. So by and large, the SPY is one of the oldest S&P 500 ETF that I know about. You can leave in the comment section if you know any other one. And this ETF continues to be one of the best that we track on the channel. Number 2 on the list is IVV, which is the Ishares Core S&P 500 ETF managed by Blackrock. The ETF has 312 billion under management and has seen a 92.86% return over the last 5 years. With a dividend yield of 1.29% and a growth rate of 4.83% over the last 5 years, this ETF shows it has a strong growth potential for its dividends. And I must say, I absolutely love the low expense ratio at 0.03% that allows me to keep the bulk of the returns while paying a quite low management fee. Finally, as expected, the holding breakdown shows technology, healthcare, and finance as again the largest exposures, with the very well-known names I mentioned earlier also in this ETF. So basically, this ETF mirrors what we saw earlier in the other one, but the lower expense ratio continues to be the deciding factor for me. Now, the third ETF on our list today is the Vanguard Sp 500 ETF, ticker VOO, which is a household name on this channel. The ETF has 240 billion under management and has returned a staggering 93.23% over the last 5 years. Now, at 1.34%, the dividend yield is quite impressive, but when you consider the 5.61% 5-year growth rate, that makes it even more attractive for me. Again, Vanguard is a household name for the lowest or one of the lowest expense ratios in the industry at 0.03%, which continues to get my attention. And finally, the sectoral allocation shows technology, healthcare, and financials again clinching the top spots in this ETF, with the names I mentioned earlier pretty much resurfacing again in this ETF. So for those that ask for a comparison, here is your summary sheet for you to understand. Now, I have subscribers that are invested in the Vanguard, I have some invested in the Spyder, and I would explain to you why, for me personally, the Vanguard looks like the most attractive to me. Now let's start out with the asset under management. We have the SPY having the biggest asset under management. We have the IVV coming in second and Vanguard coming in third at 240.24 billion. However, when you take a look at the fund growth over the last 5 years, you will see that the Vanguard has the highest fund growth at 93.23%, which is slightly higher than the SPY at 93.02%, and again, fairly higher than the IVV at 92.86%. Jumping into the dividend yield, you'll see that the VO has 1.34% as dividend yield, while the other two ETFs tie at 1.29%. Now, that extra 5 basis points of dividends makes a lot of sense to those that have large volumes in their retirement savings and also have a very long horizon. The growth story for the VOA again stands out at 5.61% growth over the last 5 years for its dividends, whereas the other two ETFs come closely behind as well. For the fees, we'll see a 0.03% for ticker VOO, that's the Vanguard, with again the Blackrock showing a 0.03% and the SPY showing a 0.09%. Makes you wonder exactly why I love the VOO, because again, in addition to these parameters, it has a low cost. Now, the last 2 points are the same for these ETFs, as they have the same exposure and also pay dividends quarterly. Wrapping up, I still will stick to the VO as my number 1 ETF, but I also definitely like the IVV and the SPY. In closing, don't just leave this video. Remember to press the like button, subscribe to the channel for more ETFs. I research ETFs on a daily basis. I just check out different types of ETFs and present the ones that I think my audience would like. And if you would like me to cover any other ETF that tickles your fancy, let me know in the comment section and I should have a look at it. With that said, thank you very much for stopping by again, and hopefully I'll see you all again in the next video. Cheers.